I am so happy to be able to welcome Carrie Hayden, who is the chair of our MBA advisory board, as well as Cameron Chandler, who is the chair of our BBA advisory board. And they are with us today to introduce our panelists. So Carrie and Cameron, I will turn it over to you.
Thank you, Christine. And I have the distinct pleasure of introducing Dr. Carlos Carvalho. I'm trying to practice it, but my Portuguese isn't quite up to speed yet. But he is one of our fantastic professors here at the school. He is the professor of statistics, and he is the La Quinta professor of business as well. His research focuses on Bayesian statistics in complex, high-dimensional problems with applications ranging from finance to genetics. Some of his current projects include work on large-scale factor models, graphics models, particle filtering, and a number of other applications. Before moving to Texas, Dr. Carvalho was part of the faculty at the University of Chicago Booth School of Business, where he was named an IBM Corporation Scholar in 2008. In 2009, we were lucky enough to get him and our esteemed institution joining us, and he was awarded the Donald D. Harrington Fellowship as well. He is receiving significant recognition for his work in analysis and insights on COVID and the Texas response in particular. He's being featured in a number of print and live media outlets, and we are really thrilled that he is with us today to talk about how we lead through this COVID crisis. And with that, Cameron, I will turn it over to you.
Wonderful. Thank you, Carrie. And now it's my pleasure to introduce Dr. John Griffin, Professor, Department of Finance. Professor John M. Griffin is currently the James A. Elkin Centennial Chair in Finance at the University of Texas McCombs School of Business. He has also served on the faculty at Arizona State University, Yale University, Hong Kong University of Science and Technology, and Harvard Business School. His research focuses on understanding the role that conflicts of interest and misreporting played in the financial crisis. A main field is forensic finance, or understanding the role of anything that is potentially illegal, illicit, or immoral in the financial markets. His research has been extensively published and cited in the top financial journals and featured in over 600 media outlets, including Bloomberg, the Wall Street Journal, the New York Times, and the Financial Times. Recent areas of study include cryptocurrencies and market manipulation. His expertise is in structured finance, credit ratings, international finance, and institutional investments, with topics of papers including the financial crisis, manipulation, mortgage, misreporting, credit ratings, insider trading, investment banking, cryptocurrencies, corruption, trading behavior, and international finance. One recent article in particular from the Wall Street Journal in August features comments from Dr. Griffin about a report he co-authored regarding reporting within the commercial mortgage industry, perhaps being partly to blame for the overstated ability of commercial property owners to repay mortgages during the disruptions of the pandemic. And I've just been recently made aware that another article has come out in Bloomberg yesterday that I know he'll be interested in mentioning. And with that, I'll pass it over to the panelists for our discussion. Thank you both for being here, and please proceed.
Well, thanks, Cameron, and thanks, Gary, for the introduction. It's a pleasure to be here, and hopefully, I don't see you, but hopefully there's a lot of our former students that may have taken my class here during their time in the MBA. So welcome back. So I think I was asked to talk a little bit about my experience during the response to the pandemic starting in early March. I think mid-March, that's when I started getting involved. And let me tell the story a bit behind what it is that ended up getting me involved with it, was that now President Jay Hartzell was asked to join a task force built from mainly the professors at the medical school and some epidemiologists at UT to help advise the city of Austin and Travis County. So a team was put together to help manage and help navigate the response in light of the sort of news and first reactions coming out of early March. If you recall, I think it was March 26th, we went into a shelter-in-place order in the city of Austin, Travis County. And then a couple of weeks after that, maybe a week after that, Governor Abbott extended that to the state, essentially putting us all into a lockdown mode. And then the reaction at that point was, again, until based on a lot of information that was not very clear, but lots of unknown variables at that point in time. And quickly, there was this realization that we needed to assemble a team to start thinking more deeply about all sorts of different aspects of the problem in order to figure out how to manage this thing going forward. And that's how I got invited to join into this team. And I got invited from the perspective of being a statistician, somebody that thinks a lot about data and gathers evidence, but also as an economist, somebody that spends a lot of times thinking about trade-offs. So my main role in that committee was to start motivating a framework to think about the trade-offs that we're facing, what it is that we're trying to do, what it is we're trying to maximize, and let's figure out what the trade-offs that we're facing at that point in time. So one of the things that was pretty clear from the very, very beginning was the fact that there was a group of scientists, in particular the folks coming out of the field of epidemiology, that were coming up with these models and projections. They were pretty dire. There were projections that would suggest that unless we did something really extreme and kept that going for a long, long time, we would have numbers of hospitalizations and deaths in the state, in the city, in the county that would be overwhelming. So just so you have an idea of numbers that were put in front of us during that period of time, it was said that unless we reduce our contacts, our social contacts, up to 90%, we would get to a situation where up to 20,000 hospitalizations would take place by mid-May or June, okay, in the Travis County area, and up to 12,000 deaths could be resulting from that. So you know, when you're faced with those numbers, obviously you can see the reactions that some of our leaders here in town and the county were quickly to act in a very strong way, saying that, listen, if we don't do something very extreme, that's what we're facing here. However, just so you know what the numbers actually came out after a lot of the things that we ended up doing, we topped at 480 hospitalizations in Travis County, and about 400 and so deaths was the peak that we observed so far at this point. So the numbers were orders of magnitude away from the projections that were made in the very beginning. So in the very beginning, we locked down. We have this idea that somehow we're going to suppress. We're going to suppress the virus. We're going to keep locked down. We're going to somehow push this. We're going to make it disappear. And it was never in the cards for us. So there was never a possibility for us to actually suppress the existence of the virus. All we could do was to mitigate. All we could do is to try to slow it down. And the sentence that was used in the very beginning was the notion of flattening the curve. So the arguments that start taking place right away was like, okay, to what degree we want to flatten this curve? So on one hand, you can think about keeping us at the levels of policies that we had in March, which would suggest that, okay, we're going to, be away from each other. We're going to be locked in our homes until when, we don't know, right? But that would be a strategy to try to minimize completely the spread of the disease and any kind of fatalities associated with COVID. On the other hand, there's this notion of, well, no, we can open up society a bit, understanding that by opening up society a bit, there will be more transmission, there will be more infections out there, which will lead to eventually more deaths as well. But it was almost an unescapable aspect of the pandemic that we're facing. We're going to have some of this. The question is when. What's it going to be now? What's it going to be later? And can we somehow smooth it out and not have this overwhelm our systems? It was very clear also from the very beginning, not from the very beginning, but like I would say by April or May, our work was showing already that there was very little doubt that we could manage this in a way that wouldn't overwhelm our healthcare resources. And they got stressed, but the fact that the idea that it would be completely overrun was something that, by looking at evidence from all over the world, it didn't seem that a reasonable prediction at that point in time. And that was part of, again, the center of the discussion. The moment you decide that your objective is to mitigate such that you don't have our healthcare system overwhelmed, that's a different calculation you have in place now. You're trying to minimize number of people in the hospitals, subject to having our lives coming back to normal to the great extent possible, right? Because that's the other part of the trade-off that was being ignored a lot in those discussions, the aspect of, You know, we're talking about jobs, we're talking about education, we're talking about lots of things that are very, very important that you cannot just ignore in thinking about the response to the pandemic. So the unfortunate part of this, that of course this became, as you all saw, politicized to an extreme early on. And it almost became like, well, if one side says this, the other side says that. And unfortunately, academics got into that type of behavior as well. So a result of that was the fact that very quickly our sort of authorities here in the Travis County area resorted to go to one side of the conversation only to listen to the folks that were suggesting suppression, which would be a complete lockdown for as long as it takes without any evaluation of the costs that we're facing as a result. And on the other hand, you see our governor and part of the Republican side of the state being more open to the notion of, no, let's actually relax things a bit. Let's let people get back to normality to a certain extent and you know, understand that this is going to lead to some infections, but we can manage it. It's something that is manageable. And that's what we end up doing, right? We end up getting into the second approach, and an approach that at first was very criticized. It was suggested that was going to, again, quickly overwhelm the system, which it didn't. And again, I think we had our work pointed out from the beginning that it was not going to be the case. At the end of the day, I see Texas at this point having had an experience since May 1st when we started our reopening that is not very dissimilar to what you saw happening in a country that chose not to partake into lockdown measures, Sweden, where we had an increase of infections. We had a peak in the summer that was, you know, not nice. It's not something that we would like to have. That's something that we had to accept to some extent. And at the same time, we were able to reduce the disruption to people's lives. We're living now at a situation where our economic activity, our unemployment rate didn't suffer as much as other places that have chosen to be in a much more stringent set of measures. They have had a more stringent set of measures in place. So that's the experience there. And I think that one of the things that I'd like to highlight in terms of the experience is that there will be no solution to this problem. This was a problem that we had to either take one end or the other end of it. And both situations were bad. And the question is, how do you want to trade those things off? It's very difficult. It's very difficult to put values on human lives. It's very difficult to think about what it is that we're giving up as a result of it. But it's unavoidable. Our leadership has to do that. And pretending that was not a choice was something that I think was very bad and I think prolonged the suffering of a lot of people for months on end in some places in the country still. They're just not really justifiable. I'll end by just talking about the fact that our schools are still at a point where, you know, they're not particularly open. They're not operating at normal levels. And the evidence that we have now from across the world is evidence that points against any measures necessary in order to stop the progression of the disease and involving schools. Schools seems to be a place where kids are very healthy, very not susceptible to extreme reactions to the disease. And their role in the epidemic is already cataloged to be very mild. So their role in the sense of the spread, right, the degree of spread. And the cost of not having your kids in school is an overwhelming cost. So when politicians making this decision are talking only to epidemiologists that might not actually understand the cost that we suffer as a society by not having our kid in school, are not looking carefully at the trade-offs they were facing. If they had labor economists sitting with them, telling them of the magnitude of the cost associated with 9 months of no schooling for our kids, it's something that you know, changes the calculation quite a bit. And unfortunately, for various reasons, that was not the case, and I think we just have to encourage more of that thinking. What are the trade-offs? What are the costs of the policies? What are the benefits? And try to you know, have that be part of the calculation and the approach that we take moving forward.
Okay, thank you, Carlos. So I wanted to talk about just kind of the macro picture, less specific to COVID, but just government policy and response. And I guess there's two main aspects in which we've seen a lot of government involvement, and that is related to the extraordinary actions of the Fed, stepping into markets and buying assets, even to the point of saying they're going to go into certain types of debt markets that they haven't gone into before. So I wanted to talk a little bit about that. And then the second aspect, which would just be the stimulus measures that have been spent recently. So let me start with the second aspect first, although they're both important. And in terms of the stimulus measures that have been used, I think there's a sense in which, since COVID is an abnormal event, it's caused by it's a virus that's come in from elsewhere and so forth. There's this idea that, you know, since it's no fault of your own, we need to save every business. I wrote an op-ed about the airlines industry and the cruise ships, but I think it's a microcosm of what's going on in general. That you have this idea that, well, here's the airline industry, poor airline industry, they really need help. And I understand that it is dramatic for the airline industry, but we have to also look at the activity of the airline industry itself and the fact that they took on literally billions and billions of dollars worth of debt over the last 5 years. And over that period as well, they paid their executives tremendous bonuses and pumped up their stock prices through repurchases. And so there are certain airline industries that are actually positioned very well. I mean, and we have two prominent examples here in Texas, actually, of differing views on this. But Southwest Airlines is a very conservatively run company, and they would be just fine weathering the pandemic by themselves. In fact, I believe it's the case that they didn't take any bailout money. Whereas you have the other airlines like American Airlines that actually has a tremendous amount of debt on their balance sheet, and so they're in a precarious position to weather the storm. Now, when the government steps in and provides bailouts, what that does is it picks winners and losers. Essentially, it hurts Southwest Airlines, and it helps American Airlines. And so what we're doing. That's a microcosm of what we're doing overall, I think, in some of these actions, which is something that academics worry about. Is called moral hazard, and moral hazard is incentive that we're creating incentives such that we're rewarding bad behavior, and that will increase bad behavior in the future. And by bad behavior, I'm not saying fraud. I'm just saying in terms of excessive risk taking or bloated balance sheets. So we're not rewarding the companies that have had more conservative type financials, but we're rewarding those people that have engaged in aggressive risk taking, excessive risk on their balance sheets. So that's one aspect of the bailout that I'm concerned about. I'm concerned also down to the PPP loans. I have a lot of sympathy for the barber and the small restaurant, but unfortunately, those are not the ones that got the PPP bailout. It's by and large, it's a lot of firms that were well connected to their financial bankers, and that were going to be just fine. And I know personally some examples of this. And they took millions of dollars, and basically it was like a big giveaway to those firms. So now we can say that we're going to get better policy and so forth, but it's very hard when you're acting quickly to make a blanket policy that's going to reward the right people. So it's an aspect of, if we're going to give out all this money, there's going to be a lot of mistakes that are happening. We've also identified in research that there's a substantial amount of fraudulent businesses that have gotten funding, and I think we'll see an increasing number of that as we look back. That there was a lot of people that got money that didn't need money. Now, I'm not saying I think giving unemployment checks, and economic research is actually showing that would be the most targeted, most direct way to help is to help with unemployment for those people that are hit hardest by this, but not try to some kind of blanket policy where we're picking winners and losers, and it's those people that get money are the ones that are mostly well connected. So that's my first concern with the policy response. We've had $3.1 trillion. We're going to have a $3.1 trillion deficit this year, of which most of it, about $2.5 trillion, is going to be related to stimulus spending. And I hear a lot of talk, like economists are saying we need more stimulus and so forth, but I haven't seen any solid evidence to suggest that we have to have this. So the question is, yes, it would help the economy if you drop a $10 trillion on it, but the economy is only 22 trillion. So what is the cost of this? And we're blowing up our deficit at the expense of future generations. And so I'm not sure that we're getting a very good bang for our buck for our dollar. People aren't going to go out and spend the money until the pandemic is over in most cases. So dropping helicopters of money on the financial system until COVID is over is really quite a waste. And the other activity is by the Fed. The Fed has engaged because they were concerned about they were concerned essentially of another banking crisis like 2009. So the lesson they wanted to do is they moved early, but the financial markets started to freeze up in March, and the Fed stepped in an extremely aggressive way, much more aggressive than they did in 2008 and 9. And when they stepped in such a big way, I think that also has the incentive to create moral hazard in markets. And as an example of that, you have to reward those people and those firms that have had conservative balance sheets. Those are the firms that would weather the financial crisis well. But by stepping in and essentially dropping all this money, buying treasuries, the government has essentially propped up the stock market in several ways. One, and I don't think it's been exactly explained how this happens. One is by the federal government, by the Fed going out and buying treasury bonds, people have to sell their treasury bonds. And so when the people sell their treasury bonds, they're not going to go out and take that money and buy more bread or fast food with that. They already have that in terms of their spending. What they're doing with that money is they're investing that in risky assets. So the most obvious place that shows up is in terms of the stock market. Two, that fuels the Fed buying long-term bond, pushes interest rates down, particularly for long-term and short-term assets. So it's pushing all rates down. And so they're also encouraging risk-taking from that measure because you can't get a return in treasury bonds right now. And so the third channel which that works is people anticipate that the Fed, when they anticipate the Fed's going to move into the market, they want to buy risky assets as well. And the fourth channel is that even though the Fed has stepped in and bought $2.5 trillion worth of assets, and so they've blown out their balance sheet, but the Fed has also indicated that they could do a lot more. So that is what market participants are talking about when they talk about the Fed put, that the Fed, if markets fall tomorrow, people have the idea that the Fed is going to, if the market falls another 20%, the Fed will step in and buy. And so that's also pushing markets. So I think that's why we see the stock market so high, is because of the extraordinary actions of the Fed. But those four channels are where how it's working. And so I guess my concern is that if assets need to be priced correctly and to reflect the risk that's in the economy. And we do have a lot of risk out. And I don't think it's the Fed's job to prop up the stock market. I think in the long run, that also picks winners and losers, because there are certain firms that probably have balance sheets such that they should go bankrupt, but because of the extraordinary actions of the Fed, they're not letting those firms go bankrupt. That's what happened in Japan. We had a lot of zombie firms, and it led to low productivity going forward. So you should reward the investors like Warren Buffett that are sitting on cash. Let them buy assets cheaply. I know some of you probably are sitting on assets and sitting on cash, and you're conservative in your finances. Why not let the market price appropriately reflect the risk? Why not let the asset prices fall? I just don't see a lot of discussion about that. And probably because people are maybe a little short term in their thinking. We all want a high stock market. Oh, this is going to help the economy, but it doesn't help to have market prices that are divorced from reality. And it's not the place of the Fed to manipulate the stock market. That's a strong word, but it has been moved by the Fed's actions. And I think that's very, very clear. And they are extraordinary actions. And so I don't think that these in the long run, I think we'll look back and we'll say, well, we took very short-term actions to try to put out a fire in March, but they're going to have very long-term costs going forward. So I worry about the moral hazard effects that we're creating as a result of the interventions in the current prices. That's my concern. I would like to hear some discussion and questions. Thank you.
Thank you so much, John. We do have a question that's come into the chat box. Lisa says, the state of Texas has had 8 times the number of COVID cases compared to the entire country of Sweden and 3 times the number of deaths. How can you say we are doing as well as they are?
All right, so can you hear me?
Yes.
Okay, good. So let's careful with the numbers, right? So the Sweden has actually not tested that many people as we have. So one of the issues that we've been facing lately is that we went look for infections. We're testing an enormous number of people in the state and in the country, and especially young, healthy people that typically, so if you think about how we used to deal with things like the flu, for example, a flu infection is something that you get diagnosed with a flu infection if, one, you test positive for the virus and you have symptoms, okay? So traditionally, we don't go out and test for a lot of people with the flu virus because people will be carriers of the flu virus without even knowing that they have. With COVID, we're doing something different for good reasons and sometimes. But given the approach the Sweden government decided to take, an approach of letting this thing burn slowly, testing is not part of their strategy. Testing for them is only testing for the vulnerable. And therefore, they're not identifying as many cases as us. So it's unclear whether we have, in a per capita basis, that many more cases than Sweden. And if you look at that, you need to look at deaths per capita. So yes, we have more deaths than Sweden. Now, of course, we're going to have more deaths than Sweden. We are much larger. Sweden is a country of 10 million people. We have close to 30 million people in Texas. And on a per capita basis, we're not very far. We're not very far in terms of deaths. And in fact, we might be a little bit worse, but you also have to remember that we start from a baseline of health status that's different in Sweden. Sweden is a particularly healthy country. And we know Sweden doesn't have the same levels of poverty in some parts, in some pockets of population that we have, which leads to basically lower health status to begin with, and of course people they're more vulnerable to potential infection and death, right? So I think it's not clear that they are doing any worse than us, or they were doing any worse than them. It's very comparable in a lot of ways.
Thanks, Carlos. We have another question from Jason. Jason asks, what would you do to reduce the impact of moral hazard? John, I think that question might be for you, but you're on mute.
Yes, thank you. That's a great question. I think you have to let firms fail. You have to let firms fail. One thing we looked at, I did, along with Sam Kruger here at University of Texas and a former PhD student, we looked at the last financial crisis, and we looked at there was a lot of banks that committed mortgage fraud, so much so that there was actually $137 billion worth of fines that were paid out by the largest banks. And that's as we all know, that money, that what they did with the mortgages and so forth also created a lot of financial harm to our system. So the government fined them for their actions, and I applaud them for doing so, because there was substantial detailed evidence of mortgage fraud found in the academic literature, as well as in these settlements. You can see the details. But the interesting thing was that when we looked at the firms and who was responsible for the fraud, down to the people that actually worked at the banks that signed the detailed loan documents, they weren't punished. And what I mean by that is not only were there's no criminal punishments, but there wasn't any job market repercussions either for those people. So that we didn't allow the free market to work in some sense. We sheltered them from the actions by the government bailing out their firms. If some of these firms would have gone bankrupt, they would have been fired. They would have lost their jobs. And they would have had, the only firm that we found really large effects was Lehman Brothers. And at Lehman Brothers, it was the case that there were some effects. And so by bailing out these firms, you're essentially you're creating moral hazard in the sense that you're rewarding the people or not allowing them to face the consequences of their actions. And so that's what I'm concerned about. I guess I would let firms go bankrupt and not get the government involved in terms of giving loans to firms that have bad finances. If a major company doesn't have enough wherewithal on their financial books to weather a 6-month storm, maybe they should have had a more prudent balance sheet beforehand. Maybe they shouldn't have engaged in all the stock buybacks, and maybe they shouldn't have paid their executives billions of dollars. And that would teach them a lesson going forward, that they need to be more conservative in their actions. So that would be my policy recommendation, would just be to not intervene.
Thanks, John. I believe our next question is also for you. Brian asks, what is the department looking for the companies committing fraud with the PPP?
So specific nature. Well, there's been some news reports about this, and also I'm not currently working on a paper about this, but I have looked at it a little bit. So one specific nature of fraud is that there's firms that are basically misreporting their number of employees. So they're like a small operation or even a shell company, but then they make a huge balance sheet and claim that there's like $2 million worth of employees that they have, and they file. So there's already a lot of suspicious patterns in the data that there's some geographic locations that don't have many businesses, but they have huge amounts of PPP funding that went to these zip codes. So there's not even that many businesses in the area, and so forth. So I think there is a big concern there, and I just, I think we'll find out later just to the extent of the magnitude of it. Sometimes you don't know if these are just anecdotes you hear, or if there are systematic patterns. I have seen some data on charities. For instance, there's charities that took loans, and the amount of loans they took was actually greater than the amount of their staff the previous year. So they either had a really large increase in staff for that year, or they're making claims that they have more staff than they actually do.
Great. We have another question coming in from Jason. Jason asks, what are your thoughts on the CMBS market?
Yes, thank you. Jason may have done his homework there. So I wrote a paper recently with one of our PhD students, Alex Priest, about the CMBS market, and what we find in the paper is that there is income overstatement on loans, and so that it's not all the originators. There's a lot of originators that have good practices, but there are certain originators that have had very aggressive underwriting, and so what they do, or what we find in the data is a very, very concrete pattern that here's a building that has income of $8.5, $9 million is their income. But when they securitize the loan, they write the income down at, let's say, $11 million. Okay. Well, they securitize the loan with a forecasted income or underwritten income of $11 million, and yet the next year the income comes in and it's only $9 million. Well, what that means is they got an outsized loan. So maybe the property should have only gotten a loan, let's say, for $80 million, but they got a loan for $100 million, and they have an incentive to take out more debt, because then they don't get any of the investors, which in this case are CMBS investors, which in this case are pension funds and insurance companies, probably a lot of them even down the street, and University of Texas type funds. If there's a loss, it's the CMBS investors that'll take the loss, and so the banks, certain banks have encouraged that kind of risky lending, and there was a bill proposed before there was a bill before Congress. It was a bipartisan bill. It hasn't gone through yet, but that particular bill is proposing that we need to help these poor CMBS originators, and we need to give them rent relief. And so my point is that is exactly the kind of moral hazard we don't need to be doing, because there is good players, there's good originators that originated these loans properly and had very strict underwriting standards, and most of those are going to be fine. They're going to be able to weather through this crisis because they didn't underwrite the building at an inflated amount. But the people that are going to be most hurt are the ones that actually wrote down inflated valuations for these properties and took on too much debt. And in fact, that's what we're seeing in the data, that the people that are on credit watch, the people that aren't making their payments, those are much, much more likely to be people that engaged in income overstatement in the past. So if Congress gives a bailout or gives a bill to help these people, we're basically giving a bailout to people that committed mortgage fraud. And so, that would be a terrible waste of taxpayer funding, but also it just creates the wrong incentives going forward. We should let the people that have engaged in honest underwriting, we should reward those people, let them buy the buildings let them go in and buy the buildings at the appropriate market price. Don't prop up these dubious origination practices.
Thanks so much, John. I'd just like to remind the audience that if you'd like to click the raise hand button, we'll unmute you and you can ask your question live as well. But since I don't see any at the moment, I'll take another question from the Q&A box from Vicky. Vicky says, how do you weigh what services we need to financially support as a critical national resource, i.e. airlines, hospitals, military, and those we do not?
You want to take that, Carlos, or want me to?
I'll take that. I would generally agree with John that in principle, unless we're talking about something very extreme, we don't support businesses. Airlines are not in the same category as hospitals. I mean, that's definitely very, very different. So it's a very difficult line to draw, and I actually have a bit of a disagreement even with John when it comes to the PPP, in the sense that I see the PPP being a reimbursement for a taking. I mean, the barbershop was told for dubious reasons to close down, and that's a taking. And getting some sort of a compensation for that makes sense. That's different in the airlines. I agree with you. That's different in the airlines. The airlines were not told necessarily to shut down. They were just like people are not consuming their product because of a pandemic. And I agree with you on that one. So it's a difficult question to draw the line, or what it is essential from a national security perspective. So an example that I'd like to give on that question, which is not related to the current crisis, is Boeing. So Boeing is a company that the government protects in a lot of different ways. And one of the reasons Boeing is protected in a lot of different ways is because Boeing has a sort of a monopoly on the defense side of a lot of things that are very important for the government. So for example, the 737 MAX situation, if there was a different unit, a different industry, my guess is that the government would have interfered a little bit more strongly and punished Boeing for that, and maybe a negative outcome would have occurred to Boeing. But I think we cannot afford to do that. It's the only producer of certain things that we maybe need as a government. And that's, I guess, what we need to do going forward is, in my view, hopefully encourage competition in the market. And if the market is too concentrated, that's a problem typically. It's a problem that we become too reliant on one particular company. That's also true for hospitals. Hospitals is a market that there's plenty of indication that is not competitive enough of a market. And that's something that we should be thinking going forward and increasing competition in the market, so that in situations of crisis, the good ones will survive, and there'll be enough competition to make the good ones come up on top. But I don't have it. I think it's very, very, very difficult to come up with the precise rule of who to support or who not to support in a situation like this.
Thanks, Carlos. Brian has another question for you, actually. He says, what are some unexpected trends arising out of this COVID-19 era?
Unexpected trends. All right. I don't know. They're asking in terms of the biology, I think, or just like things that happen as a consequence of it. I think of two things, and that has to do again with the business that I'm in, right? That I've seen, and I actually am very pleased by what we were able to accomplish educationally, even in light of the fact that people are not here on campus and so on, right? So I think in the spring, we have some evidence that things did not go off the rails too badly after the students didn't come back after spring break. There's definitely problems, but I'm not suggesting we didn't, incur a cost here. But I think we also learned very quickly that there's a lot of different things we can do. And I think that will spur innovation. I think it's one of the trends that you're going to see moving out of this crisis is that we might be, as a business, as a university, as a business, a little bit more creative about the use of technology to deliver our educational piece in a variety of different ways. On the research side, I think that Zoom has actually not have had much of an impact on our ability to communicate with our collaborators, and so it helped in a lot of ways. I think there's a lot of communities that got in closer touch as a result of this, which is also kind of rewarding. The other one that I think is really interesting is I think the reaction that people are having to public schools right now. I think public schools are not going to come out of this crisis in a good light. And the trend of people unenrolling from public schools and pursuing alternatives like charters or homeschooling is large right now. Now, it could be just a temporary thing based on the fact that the public schools are not opening in the way that parents would prefer them to open, or it might be something that shows that there are alternatives, and which there are alternatives, and maybe the demand for those alternatives might grow, which would be, I think, also something that I see in a positive light, because again, it would increase competition in that market. So those are the two things that I can think from the top of my head. John, do you have anything to say on that?
I was talking to an economist the other day, and he was highlighting that in some ways, a lot of the trends are also accelerating some trends that were present previously in the data, such that, like a good example would be the office work from home. It was a small thing, or moving to more online internet buying activity, but this has really accelerated these things, particularly online shopping, to a standpoint. So it is kind of surprising, though. I think it is surprising people that how long the pandemic is lasting. To the extent that it lasts longer, it makes some of these things that maybe become habits, changing workforce culture, maybe changing the desire of people to travel for work, the desire of people to travel for business meetings, even conferences, and so forth. So it's interesting to me, or surprising to the extent that some of these patterns that we were talking about in March or April, this may be short-term patterns, may actually be long-run, maybe long-run patterns that people just won't travel to business meetings unless it's very important. Whereas previously, you wouldn't think twice about getting on a plane and traveling to Chicago for a 2-hour meeting.
And I wonder, I'm sure there's a lot of folks in the audience that work in consulting. A lot of our students go work in consulting, and the traditional model there, they travel from Monday to Thursday, right? So the ones that are working, I wonder, what's your experience so far? I mean, have you been able to do your job, if you work for McKinsey or Deloitte or why not, while not going physically to the clients, and how different that has been, right? It would be a lot more convenient if you didn't have to go from Monday to Thursday every week.
That is a good question, and I'm sure that's going to be discussed into the future. Unfortunately, we are out of time. It goes by so quickly. Professors Griffin and Carvalho, thank you so much for your time today. For me in particular, such interesting, moral hazard considerations to think about, and so much else during this time.